You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today, I've got Jeff Dorman, the CIO of Arca. Jeff, thank you so much for being on the podcast. It is awesome to have you here. Could you start off by telling the audience a little bit about your background, your journey through finance, and you sort of made the big shift from Tradfi or traditional finance to DeFi, or I guess it's Tradfi to DeFi. So from traditional finance to decentralized finance. So could you just sort of give the audience a little bit of your personal history, your personal background on Wall Street, and and sort of talk a little bit about what that shift was like.
Yeah, sure. Thanks for having me on the show. So, I started my career, I guess, a little over 20 years ago now. And, like you said, started in traditional finance, entered straight out of college, went to investment banking at Lehman Brothers. At the time, investment banking was still sort of a cool thing to get into, right? It was high income. It was a chance to be on Wall Street, got a chance to learn a lot. There was, between the movies and books that were out, that was a job to go after. I think nowadays people not as interested in working on Wall Street, definitely looking for tech and fintech and now digital assets. But back then that was a pretty tough job to get into, pretty competitive and learned a lot. So started there, from investment banking, moved into trading, started trading fixed income from investment grade bonds all the way down to high yield distressed. Really no better way to learn about companies and structure than doing it that way, in the sense that, as you move down the credit spectrum, down to high yield and distressed companies, you learn a lot about cash flows and about valuations and how companies finance themselves and stay afloat. It's a pretty good experience there. Did that at Merrill Lynch for a long time through the financial crisis of 2008. And then after the financial crisis was when I went to the buy side for the first time. And I worked at Citadel as well as a couple smaller funds. And, the whole time value investing, again, looking up and down the capital structure of companies, trying to understand how to find value or how to create value out of a variety of different instruments. So, was involved in the debt markets, the equity markets, the real estate markets, was involved across the globe from, Asia to South America to Europe and the US. Got a chance to trade and invest in just about every sector. So really diversified experience. And then in 2014, after about 13, 14 years on Wall Street, I left the business to go to a fintech company that a friend of mine was starting. Uh-huh. And that was really my first time doing anything in my career that wasn't a straight investing a role. And it was at that time where I got to step back a little bit and be like, all this time I've been chasing returns, there's this whole other world of finance and tech out there where there's a lot of cool things going on. And we were working with developers every day. A lot of them were mining for Bitcoin and Ethereum at the time. A lot of them, all of them were using GitHub and champions of open source code and the idea of sort of the sharing economy. And that's what opened my eyes to digital assets. So started investing personally first, largely from a macro standpoint with Bitcoin, not really from a tech standpoint. But I quickly started to talk to other people in the tech community who were looking at Ethereum and other smart contract protocols, and really what blockchain could do beyond just be a currency and be a macro asset. So long story short, we started Arca 4 years ago. I started it with myself as well as a guy named Rain Steinberg, who was the head of Wisdom Tree, former co-founder of Wisdom Tree, which is a big ETF company, as well as a guy named Phil Liu, who is a securities lawyer. And really all we set out to do when we launched Arca was fill the white space that existed in digital assets, meaning there was a lot of Bitcoin only investors in the world. There were a lot of, algorithmic quantitative traders that were trading digital assets. And there was certainly a lot of venture capital investors out there trying to be early into the space. What there wasn't were, there really weren't a lot of fundamental value investors like ourselves, people who had traditional financial experience and understood how to look at the cash flows and the revenues and create valuation models and ultimately trade on events and catalysts and news and understand how tokenomics work and how to shift a token to accrue more value to token holders. And also there were very few people on the regulatory legal side who knew how to use this technology as a framework to build out other products, meaning, similar to the ETF itself was just a new version of an investment vehicle. And the first investment vehicle of an ETF was just spiders, right? The S&P. But now the ETF industry is, probably 30, 40 trillion dollars or heading that way. It has every single asset class you can imagine is represented inside of an ETF. That's what we think the power of blockchain can be as well, is that Bitcoin was the first type of a digital asset, but there's going to be thousands of digital assets in the future representing equity interest, bond and fixed income interest, real estate interest, commodity instruments, personal property, IP, et cetera. And we wanted to set out and build some of those products. So long-winded intro, but that's how I got from traditional finance into digital assets.
And so, when you were working on the trading desk back in the 90s and so, what was that like? What was that experience like? And, one thing that tends to be common among people who are in traditional finance is they naturally have a skepticism towards digital assets. One, it's very different from what they've always been doing. They've always been trading bonds and to an extent equity, futures, currencies, commodities. And there's this whole new asset. And, were you skeptical when you initially made that switch from traditional to decentralized, how to, and what was that shift like? Because I bet, running a trading desk is far, far different from running something like Arca.
Yeah, so I was incredibly skeptical coming in, and quite frankly, I don't know anybody who wasn't skeptical coming in. For a few reasons, right? First and foremost is, the market has changed a lot today versus what it was, 4 or 5 years ago. But anybody who came in through Bitcoin, very few people just understood and got Bitcoin right away, right? It is still sort of an opaque concept. It is subject to interpretation. It's more, meme than it is fundamentals. I think everybody who came in through the Bitcoin lens came in skeptical. Now, eventually you can get past that skepticism, either because you understand macroeconomics and monetary policy, or because you understand technology and what it means to have this kind of, basically sovereign, non-sovereign money instrument that can't be tampered with and is foolproof, and the blockchain itself being unhackable. Either way, that's a hard concept to get over the hump on day one, right? Most people hear about it, dismiss it, laugh at it, then eventually they're like, "Yeah, actually, maybe there's something here," and then eventually do the work on it. That's a lot different than where we are today, where you have at least 4 real applications of blockchain, right? The first being Bitcoin and money, the second being decentralized finance, the third being stable coins, and the fourth being, gaming and NFTs. And there's much more within those categories. There's also plenty of other subsectors as well, right? From Web3 to, centralized finance tokens to structured product. There's all kinds of things that are going on. A lot of those are really just hybrid instruments, right? That they are basically the combination of loyalty points and equity, right? So that's a much easier concept for people to understand. So like nowadays, when we talk to investors and we talk to hundreds of institutional investors every month, we very rarely even focus on Bitcoin, right? Bitcoin is just too hard of a concept to understand, but it's very easy to understand an Axie Infinity, right? A gaming company that produces real revenues. It's very easy to understand a sushi swap, right? A decentralized exchange that has a fixed fee attached to it and has real revenues and a real price to sales and price to earnings ratio and a real dividend yield. It's really easy to understand an ASIC-backed token, something like an NFT or something, backed by music royalties, let's say. So the starting point for investors today is actually easier than it was 3 or 4 years ago, because investors will naturally gravitate towards what they understand. And there's a lot more in the digital asset world today that mimics traditional debt and equity investing.
And I think about yesterday. You tweeted out sort of Arca's digital assets outlook, and speaking of macro, you said that macro is a tailwind and not a headwind for digital assets. So could you talk a little bit about what's going on in the macro that's actually going to cause that to be beneficial to the digital asset space?
Sure. So, and this may be a tough week to discuss that, given
Exactly.
that just everything is going down, and it's 100% at least originally caused by macro. I'm not sure it's really macro at this point. I think now you're into the capitulation, liquidations, fear kind of a phase of a sell-off. But at least there was no doubt that at least the beginning of the sell-off starting is back in mid-November and certainly accelerating today. It came from a shift from the Fed, right? It came from, a shift in macro policy. The reason I don't think this is long lasting is a couple of reasons, right? First of all, inflation pressure is going to subside, right? Most of the reason the Fed is now on a tightening cycle is because inflation is running hotter than they anticipated, right? The Fed's goal was to get to 2 to 3% inflation. Instead, we're now at 6 to 7%. But inflation, the way we monitor it via CPI, that's a year-over-year metric, right? And we were in a depression last year, or rather in 2020, right? We came out of the March 2020 COVID pandemic. Supply chains were stopped. Incomes in a lot of places were stopped. The businesses were closed. Right, that's a recessionary depression-like era. So as a result, a year later, which is now towards the middle to end of 2021, you're coming off of a really light comp, right? When you're doing year-over-year comps and you're coming off of a depression, those numbers are naturally going to be pretty high. That is going to subside now that the comps are getting tougher, right? The 2022 CPI numbers are going to be based on 2021 comps, which were much higher. So you're going to start to see that subside. Second, while inflation's a tricky concept, right? On the one hand, you want, all Keynesian economics will tell you, you want some level of inflation, right? When inflation is, low and tame, it greases the wheels of a productive capital system, right? That's what, encourages spending, encourages growth. Where it becomes a problem is when it starts to erode real purchasing problem and becomes a tax on the population. So, if we can get this under control, then you go back to what else are you going to do other than start investing your money, right? You're not going to sit on cash, right? For the last 3 weeks, people might be interested in sitting on cash because it's protecting you from 7% losses in the Nasdaq and 30% losses in digital assets and all the other short-term losses that are causing problems in the market today. But you're not going to sit on cash for 3 or 4 years in an inflationary environment. And quite the opposite, right? You're going to start investing anywhere you can and get into real estate, get into equity, build a business, do something that builds some wealth that keeps pace with inflation. So ultimately, if you have lower inflation, and even if we are in a Fed tightening cycle, you're still going to be at absolute low rates. Right, we are still in. You could raise rates, 300 basis points, and you're still in a very low absolute rates basis. And also, for anyone familiar with the real rates term, real rates are still negative. Certainly here in the U.S. and also in many places abroad. So that is not a hawkish environment, right? A hawkish environment is when real rates are really high, right? As long as inflation is higher than nominal rates, that's not a hawkish environment. So it's going to take a good 3 to 4 years for the Fed to finish its tightening cycle and for the ripple effect of tightening and reduction of liquidity to really take effect in the market. So I just don't see how anybody can look at this and be like, oh, okay, just because the Fed is about to start raising rates, that all of a sudden we're in a completely different macro regime than we were before. We're still in a low rate environment. We're still in a GDP growth environment. It is, that is an inflationary boom cycle where you want to invest in capital. And I just don't see, once we get past this 3 or 4 week or 6 week, however long it takes, once we get past this fear in the markets right now, you're going to go right back to where we were 3 months ago, 6 months ago, 9 months ago, which is low rates, tons of money in the system, invest, in anything that you can that has growth potential.
And another part of your outlook was, talking about stuff like NFTs, DAOs, and, you were very bullish on them. And usually the argument against something like that is people argue that it's speculative, it's a bubble, and, you obviously believe in, I guess, the blockchain and the DeFi from just a general structural standpoint. And so could you sort of explain why, stuff like NFTs, DAOs, etc., are not going to die out and they're sort of here to stay? There's no end of cycle, as you've pointed out.
Well, yeah, I think the end of cycle stuff is nonsense, right? I mean, first of all, for people who are thinking about 4-year cycles to start with, I mean, the digital asset market looks nothing today like it did 4 years ago, right? 4 years ago, it was Bitcoin, it was a bunch of Bitcoin forks, and it was a couple of, smart contract protocols that had absolutely no economic activity on them. They were just starting. That's a very different environment than today, where, stablecoin growth is up 400%, year over year. And, decentralized exchange volume is up 600% year over year. And, you've got TVL up 900%. And, you go down the list, like there's real economic activity happening now. There's real sectors, there's real applications, there's real protocol growth. That's a very different environment. So to just, decide that this is going to be the same 4-year cycle as we saw 4 years before, to me, that's crazy. That being said, the reason we're bullish on certain specific assets is that, digital assets have solved for something that no one's ever solved for. That is the coordination of all stakeholders and the ability to bootstrap growth through incentives and rewards, where everybody who is a participant in a company or a network gets to grow alongside you. So, for example, like one of the things I like to think about is, look at DoorDash, for example. Right, DoorDash, recent IPO last year. DoorDash created billions of dollars of wealth for a handful of early stage investors and a couple of the founders, but it created no wealth at all for the regular people who made DoorDash successful. Right? Who are those people? The people who cook food, the people who eat food, the people who ride bikes and deliver food. Right? Airbnb created billions of dollars for venture firms. Didn't create any value for the people who own homes and rent them out, for the people who rent home or vacation in homes. The whole point is, like, this Web 2 economy has rewarded the middleman in the technology stack, but not at all rewarded the users and the customers and the people who make it happen. Where we're headed with Web 3 and with all digital assets is it flips that on the head. If you're an early participant or you're a member of a community or a growth asset, you're going to be compensated for helping to grow that. And that's a big deal. Now, once you establish that, then you can move into these other areas where this technology also makes sense. So, for instance, NFTs get a lot of press around, art and collectibles, and, Beeple sells a painting for 60, or, digital art for $69 million, or, CryptoPunks sell for millions of dollars. That's just one sleeve of what an NFT really is. Ultimately, all an NFT is the digitization of an asset that can be owned. Right. So where we're headed may be less sexy. It might be boring, but it's going to be, trillions of dollars of economic activity. So, for instance, all intellectual property, right? All IP can be represented as an NFT. If your parents still, cut out coupons in the Sunday paper or in a magazine, like, coupons will be NFTs. Your health records will probably be an NFT. Where you can release it to different hospitals and medical fields as you see fit. You are going to see all kinds of in-game assets, right, in the gaming world, from digital land to skins and other things that you collect within a game. That'll be digitized. The deed to your house will be digitized as an NFT. And once you start to bring all these things into NFT form, all of a sudden, you never need to own cash ever again, right? The only reason we own cash is to pay bills and to, make sure that we have something liquid if we need to do something. Well, if one day all of your assets are on chain and you can borrow and lend against them and they're all tradable and there's a market for everything, they never need to own cash. You can be 100% invested at all times. And when you go spend money, you just say, take a little bit out of my jewelry NFT, take a little bit out of my home equity NFT, take a little bit out of, my Tesla digitized stock. And it just creates a better, it's a better system. It's a better system of coordination and stakeholder alignment. It's a better system of liquidity and across asset coordination. So it would be crazy to care about a couple of Fed rate hikes when you have this kind of a growth of a technology in an asset.
Right, and you've also talked a bit about fully diluted value and how that's a misleading indicator. So one, could you explain what fully diluted value is, and how do you actually think about valuing a digital asset?
Sure. So, like most things in this space, it's nuanced. We built this technology on Bitcoin, and then as a result, there's a lot of terminology and a lot of valuation techniques and a lot of investing that is all based on that everything is some version of Bitcoin, and it's just incorrect, right? All of these different assets are different. You have different issuer types, from potentially one-day governments with CBDCs to corporations to DAOs to individuals. You have different token types, from protocol tokens to asset-backed tokens to pass-through tokens to currencies. And as a result, you have different valuation techniques, right? It's not a one-stop shop. So, if I'm valuing Bitcoin, I just throw my hands in the air and say there is no way to value Bitcoin, right? You give me all the charts and all the data you want, but that's not a valuation technique. That's relative value, right? Ultimately, the only way to value Bitcoin is based on what you think it's worth relative to something else. If you look at a protocol, you can value a protocol often the same way that you would a country, right? Here is some blank canvas that if and when roads and buildings and shops and schools are built upon it, eventually there'll be tax revenue, and that goes to the government. Well, protocol is the same thing, right? It's a blank canvas or a blank app store. And as these apps are built on it and there's economic activity, those transaction fees accrue to the protocol. So therefore, we can look at like a discounted cash flow model or some sort of a financial model looking at the revenue and tax collection of the protocol. If I'm looking at an application that has real revenues and cash flows, then I'm going to use dividend discount models or free cash flow models to understand what those cash flows are worth, right? That's something like a gaming app or a DeFi app. So we look at all these different things when we're looking to value these tokens, some of which can be valued more easily than others. But one of the concepts, there's many concepts that I think they're outdated, but one of the concepts that I think is very misleading is this idea of circulating market cap versus fully diluted. So circulating market cap, so I'll give you an example. A token project decides they just issue 100 million tokens, or create 100 million tokens, but they decide to sell 20 million of those 100 million to the market. Okay. And let's say you sell them all at $1 just to make the math easy. Well, right away, your circulating market cap is $20 million, right? The 20 million tokens you sold at $1, but your fully diluted market cap is $100 million because technically there's 100 million tokens outstanding. But that extra 80 million of tokens that are sitting there on the company or on the DAO or on the issuer's balance sheet, those tokens may or may not ever get issued to the public, right? Just because they exist doesn't mean they're ever going to come to market. And we've seen, many examples now of, projects either burning those tokens or delaying a schedule in terms of when they're going to release it. We've also seen examples in the other way, like Yearn Finance, Wi-Fi, for example. Wi-Fi had a fixed number of tokens on day one and said that, that was a big case for Wi-Fi. We're never going to adjust the supply schedule. It's always going to be fixed. And then what they do, they voted on increasing the supply and they created more tokens. So the point is, you can't just look at the fully diluted value because you have to make some assumptions as to when are these tokens going to become public and in the market's float, and if and when that ever actually happens, and how it gets sold. And in the same way, that's no different than what you do in the debt and equity market, right? A company can issue basically as much debt as investors will buy from it, subject to some covenants that are put in place, which in a lot of cases there are no covenants, but high yield and distressed companies do have covenants. In the equity market, you have an authorized number of shares and you can issue up to that authorized number, but most companies don't issue anywhere close to their authorized share count, which is basically the same thing as fully diluted supply, right? These are shares that could be issued but aren't issued yet, and the company may or may not issue those. Also, if they ever get to the fully authorized share number, they can just go to the board and request authorization to increase the share count. So the point is, all of these numbers are fluid. And to just say because they were created using using code, just because they exist doesn't mean you count them. So it's nuanced, and you have to really have some assumptions as to when these tokens are going to come to market and how. And sometimes you include that in your analysis, and sometimes you don't, depending on those assumptions.
And speaking of net worth, two of them that you've sort of been bullish on having Ronin and Sushi. So could you sort of describe, the dynamics behind Ronin and Sushi and, what the bullish case is for them?
Sure. So two completely different
Yep.
assets, but you'll start with Sushi because that's pretty easy, right? I mean, Sushi Swap is a decentralized exchange. It is, one of the easiest businesses to understand in digital assets, in the sense that it is, you go there to trade your assets. You start with one asset, you trade it for another asset, and a fee is earned by the protocol for you doing that. It's a fixed fee as of today of 30 basis points. So it's very easy to figure out the revenues of the business as long as you know the volumes that go through. And because this is all on chain, you can see the KPIs and the metrics, just by understanding how to read the data, whether you're doing it yourself, via an API, or you're looking at something like a Dune Analytics. Once you know the revenue of that 30 basis point fee, 1/6 of it, or 5 of those 30 basis points, gets paid out in a dividend to Sushi token holders. So for us as an investor, there's a couple of things we look at, right? One is, this is a business that works, right? There's billions of dollars of volume that go through. It's the second largest decentralized exchange. More importantly, it is, they're generating anywhere, depending on run rate revenue you're looking at, but they're generating or somewhere between 500 million and $1 billion of run rate revenue. And the overall decentralized exchange industry, like I said, is growing about 500% year over year. So you have a huge growth industry. You have the second biggest company or project in that industry, and you have real revenues and cash flows accruing to token holders. That's as easy of a formula as you'll ever see for investing. What you didn't have was strong management, and that's because this was a DAO. And in any DAO, you are going to have issues with regard to how that company or project is run. So as a distressed investor, and Sushi from a token price standpoint was certainly distressed. It was down 80% at one point from the highs. That's what you look for. You look for strong product market fit, strong growth, strong traction, real cash flows, but something that needs to be fixed. And what needed to be fixed was a real strategy and a real management plan. So we went out to help them fix that in the form of using our investment in the project to steer governance to fix that. And we think Sushi is going to be a home run when you actually look at all the different products that they've put together and all the different product lines that have created a sticky customer base and a lot of traction. Ronin is something totally different, right? Ronin, the token doesn't even exist yet. You wouldn't even be able to find it on CoinGecko or CoinMarketCap. But Ronin is part of the Axie Infinity ecosystem. So Axie Infinity being one of the most popular blockchain-based games. Axie Infinity, built on the Ethereum protocol. Obviously, that's not the best blockchain for something that requires a lot of speed and low transaction costs, right? The big knock on Ethereum has obviously been the throughput and the fees that are attached to gas on Ethereum. So Ronin built its own sidechain Axie Infinity or Sky Mavis built its own sidechain called Ronin, and Ronin is basically doing about 5 billion of TVL, which would put it at the number 2 biggest layer 2 and bridge in the market. As a result, if you look at where something like a Polygon trades in the market, or you look at even something like Avalanche, this is going to be a multiple billion-dollar protocol. And on top of it, Ronin has its own DEX, its own decentralized exchange called Katana. And Katana is doing all of the transactions of everything with Axie Infinity, including all future games of Sky Mavis. So this is going to be a new token that gets issued to market, but unlike a lot of tokens that come to market, you can't buy it yet. The only way to get it is to farm it by either owning Axie or owning SLP and farming for Ronin tokens. So when and if Ronin comes to market, which we believe is in the next couple of weeks or so, that should be $1 billion to $2 billion market just based on comparable comps and basing. Sorry?
I was like, wow.
Yeah, I mean, that should be, if you just look at the way most things trade in this market, most things in the market right now trade somewhere between 1 to even 3 times market cap to TVL. So when you look at Ronin, which is, like I said, has 5 billion of total TVL, but maybe depending on which metrics you're looking at, you could say it's only $1 billion if you look at just the decentralized exchange. Either way, this should be over $1 billion of value for this protocol. And they're just giving it away to people who are part of the Axie Infinity ecosystem. So when it prices, if this ends up pricing at only a couple hundred million or whatever case may be in the early days, to me, this is one of the easiest setups you'll see is again, a growing ecosystem of Sky Mavis and Axie Infinity, real traction before the token even launches, and clear-cut cash flows and revenues from the Katana DEX. So, that's what we look for when we're investing, right? We don't want to invest in a token that doesn't have a business. We want to invest in a business that doesn't have a token. And when they introduce the token, it increases the usage of that business, and ultimately you, as the token holder, get to accrue that value.
And that's what I was about to come to next. So when it comes to your investment or research process as it relates to the DeFi space, how do you go about filtering new ideas? There are plenty of new ideas, and there are plenty of networks that are basically started every day. And so how do you go about filtering what looks the best? And once that ideation process is completed, what goes on after that before before you sort of make an investment decision?
Sure. So we're looking at a lot of different things. I mean, first of all, Arca, we have the benefit of having, a very large company that's very well resourced and, has a large team that spends 24/7 looking at this. But in terms of our research process, again, it looks very similar to what we did in the debt and equity world. Is first, we are trying to identify themes that we believe are going to be impactful. Then we are looking for the individual companies or projects that are going to help us fit that theme. And then we do a bottoms-up analysis of whether or not that's going to be a good investment, which means looking at the total addressable market, looking at the revenues and cash flows, looking at how the token accrues value, looking at the management team. There's thousands of companies and projects that we know nothing about. We're not. It would be impossible and also unnecessary to try to cover this entire universe. What we do is try to drill it down into subsectors of what we like in the market, and try to find 20 to 30 investments every year that we think will help us achieve those goals.
Mm-hmm. And so, where else do you see opportunity beyond sushi swaps and Ronin for now?
I mean, rather than go through individual tokens, I'm sure your audience would love that, but that's not what we do here at Arca. We keep our investments to ourselves. Once in a while, we'll tweet about them. So for people who want to follow me at jdorman81 or read our
But
blog.
Generally speaking, where else do you see opportunity?
Sure. We see a lot of opportunity thematically still in some of the sectors we've already mentioned, right? We're still very bullish on DeFi, but not all of DeFi. For instance, like we're very bullish on decentralized exchanges. We're very bullish on insurance. We're not that interested in asset management. We're not that interested in lending and borrowing, just because we don't think the tokens necessarily accrue that economic value. We're still very interested and big in gaming and NFTs. Again, NFTs is to us much bigger than collecting the individual NFTs of art and collectibles, but looking at those other subsectors that I already mentioned, like in-game assets, and land, digital land, and even sports and social and music and digital identity and things like that. So we're making a lot of investments there. We're also very interested in anything related to rewards, which is a little bit of a catch-all. But we think, again, this idea of being able to reward your early users and your customers rather than forcing them to go buy equity separately, we think that's really powerful. So we're looking for all companies that, again, they exist without blockchain, but that they are trying to use blockchain in some capacity and are introducing a token to their stakeholders to encourage them to utilize the platform and ultimately to become power users and evangelists. We're looking a lot into infrastructure around trading and derivatives, and we're still looking at different pockets of Web 3.0. So like we're very invested in decentralized storage, something like an Arweave, and looking for other B2C as well as even B2B businesses, from a logistics standpoint or from a telecom standpoint that are starting to tap into blockchain as a method for growing their business.
And with so much going on, a lot of people tend to talk about the risk of fraud within the DeFi space. So they tend the primary argument is with stuff like Tether, which is a stable coin, and a lot of people argue that a lot of Tether's reserves simply don't exist. So when it comes to risk of fraud, how do you think about it? And as an investor, what are the signs you look for to avoid it?
Well, I guess first I would ask you what you mean by fraud, right? I mean, there
are plenty of coins that are started purely to benefit, or there are plenty of, say, pump and dump schemes within the entire universe. So,
well, I mean, look, the reality is, if you're coming at this as an investor, you should always be doing your homework, regardless of whether it's a debt instrument, an equity instrument, real estate, or tokens, right? The most of the quote unquote pump and dumps or fraud, if you spend even 10 minutes of due diligence, you'd see somebody raising the red flag on that, right? The information is out there. This is probably one of the most public and transparent spaces that I've ever been in, if you actually spend the time to do it right. Like I said, part of our framework is, we look at management, we look at the creator, we look at all these different factors to do our due diligence. And if something is a red flag, we're not going to invest in it. That's different than being a customer or a user, right? You could, if you start depositing assets on a DeFi platform or into a gaming platform, and they pull, they rug you and you lose all your assets. That's a different level of due diligence, right? Because you're no longer making an assessment there on what the upside of that business is. You're trying to make an assessment on whether or not your assets are safe. That's a lot more difficult. It's much more difficult to really figure that out unless you know how to do a security audit, or how to find the areas with which some of those things would be exploited. They're not mutually exclusive, though, right? In the same way that I could be a Delta Airlines shareholder without ever flying on an airplane, and vice versa, I could be a frequent flyer without ever owning Delta stock. The same is true of digital assets, right? You could be a power user of a game or a DeFi platform without ever really wanting to own their token, or you could own the tokens as a passive investment without ever being a user. It's not the ideal way to do it, as we just mentioned. One of the benefits of the space is to be able to do both and to be, a customer and a stakeholder at the same time. But you could do that, right? So it's a lot less risky to just own a token and try to participate in that upside than it is to park your assets in a protocol without understanding what the smart contract risk is and everything there. But the longer or the shorter answer, I suppose, is just do some research, spend 10 minutes, Google it, spend some time in the Discord, spend some time in Telegram, look on YouTube. Like, there's a lot of people out there flagging the ones that are obviously going to be fraudulent. And fraudulent is different than it not working. Right? There's plenty of projects that just don't work. That doesn't make it fraudulent. It means somebody tried something and it didn't work. That's different than intentionally trying to steal your money or to steal or run away with assets. So again, I would use the word fraud sparingly, but you do, like most things, you do your homework, you spend your time, and you'll be able to uncover a lot.
Yep. And when it comes to just thinking about, so for example, I'm in my freshman year of school right now, and when it comes to people who are going into finance in 4 to 5 years, do you think the dominant force is going to be DeFi versus traditional finance? And a lot of people are simply going to finance to sort of end up on Wall Street, go up through, I guess, the ranks on a bulge bracket investment bank, for example. Or do you think that sort of career path is eventually over the next 5 to 10 years going to be replaced by DeFi? Or what are your thoughts? What are your thoughts on the longer term outlook on the industry as a whole?
Well, I mean, the beauty of this industry 3 to 5 years ago was that, while everybody is somewhat money motivated, there wasn't a lot of money in this space, right? So most of the people who were in this space were doing it because they really enjoyed it. They really liked it. They wanted to be a part of it. Now it's a little murkier, right? There's a lot of mercenaries who are coming in from, I get resumes every single day from BlackRock and Citi and JP Morgan and Goldman and Bridgewater. Everybody wants to get into digital assets. That doesn't necessarily mean that has to be the place you start, though. For instance, I don't think anybody should be a trader as their first job. I think that is the least transferable skill and the hardest to learn. I think being a research analyst or being an investment banker is a great place to start your career, because you learn a skill set that you can use the rest of your life, right? Even if you start as a Wall Street research analyst or an investment banking analyst, you could go on to run a company or to, work in the industry and do a lot of different things. So, I don't think Wall Street is dead. I don't think traditional finance is dead by any means. I think it is less attractive because there's a lot of other opportunities that, allow you to dress differently and allow you to work different hours and, potentially pay you just as much. But there will always be people who are looking for that kind of training and that kind of job. And I certainly wouldn't advise people against it. I would just say that if that's not what your passion is, or if you're not looking to, spend 2 to 3 years of your life, working in a machine, then it might not be for you. But if you're looking for a broad-based knowledge set, it's still a great place to go.
Got it. Do you have anything else that you would like to talk about that we didn't cover so far?
No, I'd say this is the most fun I've ever had in my career. It is an awesome industry. There's there's limitless opportunity. It is the only space I've ever been involved in where I never feel like I missed something because there's always another opportunity around the corner. It's growing faster than any of us could have thought. There's more sectors, tokens, ideas, and quite frankly, I'd imagine most people know how to do a little bit of coding at this point. It's the most hands-on industry ever, right? I mean, there are people who have made life-changing amounts of money just by participating in early games or participating in early networks. And that's pretty awesome, right? That you can basically do the research, find a community you believe in, be an early participant, and be rewarded for doing so. That doesn't exist everywhere in the world. So I think the opportunity is vastly superior to a lot of other things out there in other industries.
And to wrap up the podcast, what are your favorite resources that you would recommend to someone just starting out, learning about DeFi?
Specific to DeFi or just in general digital assets?
Well, just in general digital assets.
Sure. So, like most things, you gotta put the time in. You gotta find a couple of resources that you trust and read about and learn. So, I already mentioned, our blog that we send out weekly on our website at ar.ca, but there's plenty of other ones. So I would say, definitely read the news, which, CoinDesk and The Block are good sources for that. Maybe sign up for a third-party research firm or two to get some more information, like the Block or Masari or Delphi Digital. There's tons of great newsletters out there, from Glassnode to the Defiant. So find a couple things, right? There's one thing I know about young people now, and I'm an old man, but the younger generation is very good at researching new information and where to find things. Like, there's no shortage of information out there, but try to find a source or two that you really trust and keep going back to the well rather than getting a ton of just contradictory information from a lot of different places, right? There's also a fair amount of noise in this space. And you definitely want to try to filter some signal through the noise there. And then in terms of whether you're investing or trying to learn how to use this stuff, I mean, definitely put a little bit of money into it. You don't need tens of thousands of dollars. Start with a couple $100 and play around. Get a feel for owning some sort of a digital asset and putting it on your own self-hosted wallet and interacting with a protocol. And get a feel for how it works. How do the assets move? What do you do with a private key? What kind of different features can you use? How do you farm for different tokens? The more you do with your own money, the more likely you are to learn.
Yep. And with that, Jeff, thank you so much for being on the podcast. It was awesome having you. I think this is the first DeFi discussion I've had in a while. So thank you so much for being on.
Absolutely. Happy to help out and appreciate the work you're doing to educate people.